Today, the Cornell Capital Group is introducing a new index, the CCG Unprofitable Index. But before we get there, a little history. A decade or so ago, many corporate CEOs, along with Nobel Prize winners Richard Thaler and Daniel Kahneman, were wringing their hands about what they called market myopia. What this meant was that investors were too focused on the next quarter's earnings. They couldn't see the long term, and the executives and the Nobel Prize winners were concerned that companies couldn't pursue long-term goals in the context of this investor myopia. Well, that's all so yesterday. In recent years, the market has been rewarding companies that have long-term dreams and plans, even if they don't make a penny yet and have never made a penny. If they can convince the market that they're the future, the market has been rewarding them. And to see how strong this effect might be, the Cornell Capital Group developed its new Unprofitable Index. And Director of Research Andrew Cornell used the following criterion to select the companies. First, they've never had, or basically never had, a profitable quarter as measured by generally accepted accounting principles, net income. Second, they aren't tiny little companies. They have to have a market capitalization of at least $10 billion. And many of them have a market capitalization over $25 billion. And one of them, in fact, has a market capitalization greater than $100 billion. So these are all very substantial companies, at least as measured by value. And they're also very widely followed and actively traded. So that's the group. And what we'd like to do is see how these unprofitable companies that have not made a penny have done relative to the market index, such as the S&P 500. So let me go to the iPad, and we have that information here. This is the CCG Unprofitable Index versus the S&P 500. The yellow line is the S&P 500 as measured by the SPY Exchange Traded Fund. And the blue line is the Cornell Capital Group Index of Unprofitable Companies. And what we do here is we start both of them at 100 on January 1st of 2020. And then we go forward from there. We pick 100 as a starting point because that's reasonable, and we want to start them at the same point. But from that point, as you go forward, it just reflects the returns on these two investments. And up through last Friday, I believe it was, on June 24, you can see that the S&P's done well. It's up from January 1st of 2020. It's risen 31% through June 24th. That's a happy return. I mean, that's a healthy return. I'd be very happy with that. But the unprofitable companies have risen a remarkable 288%. I think that deserves an exclamation point. These are companies that during this entire period and their prior histories never made a penny of net income, yet they rose 288%. So our index reveals to us that the market is no longer myopic, it's hyperoptic. That's the term for farsightedness. The market is rewarding companies with big dreams much more than companies with current earnings. Now there's one fly in the ointment. Howard Marks, the founder of Oaktree and a well-known investor who became a billionaire through his investment insight, has noted that the sentiment for believing in the future tends to run hot and cold. Right now it's running very hot. Companies that are in the future have been, as we've shown, dramatically increasing, whereas those that have current earnings are rising at a much more pedestrian rate. But things can change. And if that sentiment changes, and if people become fearful, and they want to see current earnings, who knows what can happen to the unprofitable index. But what we at the Cornell Capital Group recommend you do is follow our unprofitable index. It's like a canary in a coal mine. It should tell you how sentiment is moving. And recently, it's been moving straight up.